Hey, how's it going, everybody? In today's video, I'm going to talk about the types of policies, the types of life insurance policies, part 2. Now, if you have not already, be sure to check out my other video I did over types of policy, part 1, which I covered term life insurance and whole life insurance and some of the different whole life insurance that there are available. So, with that being said, let's go ahead and get into this slideshow, this PowerPoint presentation. So, for the overview of what we're going to be discussing in this PowerPoint is interest sensitive policies, specialized or combined policies, and what are some of the tax rules for premiums and proceeds payments, or proceeds, payments. Okay, so the first thing that we have is interest-sensitive policies, interest-sensitive life insurance policies. What is that? So, interest-sensitive policies have higher interest rates on the cash value than what we see on just our normal traditional whole life policies. So, here are 3 types of interest sensitive whole life policies. The first one that we have is universal life, which we're going to be diving into. We also have variable life and index life. So, universal life. What is universal life? Well, universal life is the combination of terms and cash value that is invested at a guaranteed minimum interest. So, with universal life, it's a flexible premium. It's known as a generic name of a flexible premium to adjustable life. So the policy owner has more flexibility. So they don't necessarily have to pay each premium every single time. They're able to skip paying premiums, and the policy will not necessarily lapse, just as long as there's enough money or there's a significant amount of cash value at the time to cover the monthly deductions for the cost of insurance. So you get more leeway with universal life. You're able to adjust your premiums. The insurance company may give the policy owner a choice to either pay for, well, they can either do 2 things when it comes to their premiums. Their premiums can either be minimum, so they pay the minimum premium, which pretty much keeps the policy enforced for a current year. Or they can do a target premium, which is the recommended amount that's paid into the policy in order for the policy to have a cost of insurance protection and to keep that policy alive and well. So with the same thing with whole life, universal life offers that the policy lasts until age 100. So premiums are paid and combined with the interest earned. So the 2 bullet points that we see down here with the premiums that are paid in combination with the interest earned is they first pay for the insurer's cost of doing business. And then the second thing is the cost of the term policy. So any money that's left over becomes the cash value in the policy. So with universal life, you get more flexibility compared to term life and the other life insurance policies. So what are some advantages of universal life? Universal life gives the insured the right to adjust the premiums or the death benefit. They can do either or. You also are able to do partial surrender in universal life. That happens with no interest charge. So the cash value is just reduced. So if you partially want to take out some money, you can do that. And universal life policy will allow partial withdrawal or partial surrender of the policy's cash value. However, there may not be a charge for each withdrawal, or there may be a charge for each withdrawal, and there is usually limits that show how much and how often your withdrawings are made. So the next kind of life insurance or sensitive or interest sensitive life insurance that we have is variable life insurance. Variable life insurance is sometimes referred to as variable whole life insurance. And we see that there is a level fixed premium. And there's also a investment-based product. So this is also an investment-based product. So you get both. You get both permanent coverage with a guaranteed minimum death benefit. So what happens to the cash value? The cash value is invested into common stocks, which means that with the variable life or the variable whole life or universal life insurance, you see that there's going to be a separate account. You have to have a separate account. So with variable whole life insurance, the cash value for this policy is not guaranteed because the cash value is invested into common stocks. We know that stocks fluctuate. They go up and down based off of the performance of the portfolio. Which the premiums have been invested by the insurer. So the insurer invests the cash value into common stocks. There's no guarantee that we're going to actually make money off of the cash value. It's all going to be based off of what the market is doing at the time. If the market is good, okay, so you might see a little something in your cash value. If the market is down, we're going to see that as well. So the policy owner bears the investment risk in the variable contracts. So, because the insurance company is not sustaining the investment risk of the contract, there is a underlining assets of the contract that cannot be kept in the insurance company's general account. So that's how we get that separate account. The separate account holds these assets in which is invested in stocks, in bonds, in other investment options. So cash value is not guaranteed. The market goes up and down, sideways, all that. So we may not see that money in our cash value. The investments must be in a separate account to protect the other account, to protect our death benefit. So the separate account is held by the insurer. All right. So within this separate account, like I just talked about, the cash value or the cash that's in there is invested in stocks and bonds when it comes to variable separate account. FINRA. What is FINRA? FINRA comes into play. It's a financial industry regulatory authority and individual state insurance department, which requires that an agent that's selling these products, that's selling variable whole life, must have both an insurance and a securities license. They must have both. So when we see, so this is another kind of interest sensitive. It's equity index life insurance. Equity index life insurance. So it's whole life insurance that's linked to a public index. It's linked to a public index fund. So the insurance that is the cash value is dependent upon the performance of the equity index, and this is linked to S&P 500. So we see that sometimes is linked to interest sensitive or index life insurance. So although there is a guaranteed minimum interest, so with variable whole life, there wasn't a guaranteed, with variable whole life, there was not a guarantee with our cash value and actually getting money back with our cash value. But in the index life insurance, so cash value is dependent upon the performance of the index life insurance. So the index life insurance is linked to, sometimes we see it's linked to S&P 500. And with that, there is a guaranteed minimum interest. So the policy's face amount or death benefit will increase annually to keep pace with inflation. So this is a good life insurance policy to have if you want to do investments. If you're big on investments, you're interested in investments. When you get a index life insurance, the policy is not affected. It's not affected by if the market goes up and down. You're still going to get a minimum guaranteed interest rate. So it has a conservative guaranteed minimum interest rate to protect against downturns within the market. So if something happens in the market, that's not going to affect your minimum interest rate. You're going to get a guaranteed minimum interest rate regardless of what the market is doing. So it's just something to help protect against the inflation and fluctuation. So as the consumer price index increases, you don't need any proof of evidence of insurability. Index whole life policies are classified depending on whether the policy owner or the insurer assumes inflation risk. So if the policy owner assumes the risk, then the policy premiums will increase, which increases the face amount. If the insurer assumes the risk, then the premiums remain level. So this kind of life insurance, index life insurance, can potentially grow faster if the market is doing well. It can grow a lot faster. Okay, so the next kind of these next kind of policies I want to talk about, they have a combination of whole life and term and universal. They have all these combinations incorporated in it. So we're going to talk about joint. We're going to talk about joint life insurance. We're going to talk about survivor life insurance, juvenile life insurance, MAC, modified endowment contracts, group life insurance, and credit life insurance. So we're going to talk about all these things very briefly. So what's joint life insurance? Well, joint life insurance is a single policy that is designed to insure 2 or more lives. So it's based off of the first to die. So the premiums is, the death benefit is paid to the person that passes away first. So, so the death benefit is paid upon the first death only. So we see this a lot in business insurance. A lot of the times when companies pull out life insurance policies, they pull out a joint life. So the first to die. When the death benefit gets paid out when the first insured passes away. After that, the agreement or the life insurance policy is terminated. Once the first person, whoever passes away first, will, the other person will get the death benefit. So for example, we have a married couple. So this is our married couple right here. The married couple purchases a house and may use a joint life insurance or a joint life policy for the mortgage protection. If both spouses work and earn close to the same amount of income, so if one spouse dies, the insurer pays the mortgage for the surviving spouse. So joint life insurance is also used to insure the lives of business partners. So we see this in funding of buying a sales agreement and other businesses' life needs. So they buy-sell is a business continuation agreement that determines what will be done with the business in the event that the owner dies or becomes disabled. That's something that you got to think about. So one important thing to remember about joint life insurance policies is the premium rate. So what is the premium rates like on joint life insurance? Well, the premium rates on joint life insurance is determined by the averaging ages of both the insured. So that's how they're going to base the premiums. They're going to get both of these two happy couple. They're going to get their age and add it up and divide it by 2 to get their average. And that's how they're going to set the premium rates. All right, so when we got survivorship, that's second to die. The last survivor. So this is much similar to joint life. That's where we have it insures it insures 2 or more lives for a premium that is based on a joint age. So the major difference between survivorship life is the major difference between joint life and survivorship life is with survivorship life, it pays on the last death rather than upon the first death. So since the death benefit is not paid until the last death, well, the joint life expectancy is in a sense extended, which is going to give you a lower premium than what you'll typically get charged with a joint life insurance. So it's extended out longer. So, like I said, the major difference is the death benefit gets paid out once the last person passes away. So, this is the type of policy that is often used to offset a liability of an estate tax upon the death of the last insured. So, one thing to remember, and if you're studying for your life insurance exam, remember that joint life equals first to die, and survivorship life equals second to die, the last survivor. Alright, so the next kind of life insurance policy that we have, or a special combination life insurance policy that we have, is juvenile life. So juvenile life is a policy that is written on the life of a child within a certain age limit. So this is, it normally goes up to like age, it normally goes up to like age 18 or something like that. So policy owner is normally the parent in this situation, or the guardian, or whoever is the whoever has custody, or whoever's responsible for the child. So the next kind of special life insurance that we have is modified endowment contract, or MACs. So they got the same. Once a MAC, always a MAC. So what is MAC? What does that actually mean? It's a whole life insurance policy that will have the loss, that has already lost tax advantages of a regular life insurance policy. So this is normally when we see a MAC life insurance policy, it's normally stems from a huge amount of payment. So a MAC, or a modified endowment contract, is a single premium life insurance that remained as one of a few financial products offering significant tax advantages. So consequently, many of these types of policies were purchased solely for the purpose of setting aside large sums of money for the tax-deferred growth, as well as tax-free cash flow available via policy loans and partial surrenders. So when we see a MAC, it doesn't pass the 7-day test. So what is the 7-day test? Any 7-day test. All life insurance policies are subject to 7-pay test. 7-pay test. So any time there is a material change in a policy, such as an increase in the death benefit, and if there's a new 7-pay period, a new 7-pay period is required. So if it doesn't pass that, or if it doesn't pass the 7-pay test, then it loses its tax advantages. So as we can see here, there are some taxation rules that apply to max cash value. So the first thing is MACs are tax deferred accumulation. Any distributions are taxable including withdrawals in policy loans. Distributions are taxed as LIFO basis, last in, first out. This is known as interest first rule. And distributions before age 59 and a half are subject to 10-year penalty. So remember this one thing about Mac. Once a Mac, you're always a Mac. Alright, so group life insurance. What is group life insurance? What does group life insurance look like? And why do we even have group life insurance? So group life insurance covers many individuals underneath one policy. Many people have group life insurance. When I worked for my first career job, I signed up during open enrollment. I signed up for group life insurance. And you know, it's neither a good thing or a bad thing. I do believe that having your own, being your own policy owner of your policy is better. You know, you get more advantages, more flexibility, but also there are advantages when it comes to group life insurance, which we're going to talk about. So, master contract is the policy that is issued to the policy owner. And a certificate of insurance is what the employee is normally issued that shows that they have proof of insurance. So with life insurance beneficiary, of course, the individual insured has the right to choose who's going to be the beneficiary. The employer doesn't have the right, the insured doesn't have the right to say who's going to be in charge or who is the beneficiary. The policy owner doesn't have that right. When it comes to group life insurance, the individual insured gets that right. So, what happens in group life insurance underwriting process? What's that look like? Well, since they are giving a group life insurance policy, underwriting is not required. This is significantly less. It's going to have a less cost premium, well, a reduced amount of premium cost because it's a individual insurance. It's not individual insurance, sorry. So with individual insurance, you have a higher premium, but with group insurance, it's less. And this also reduces adverse selection as well as it reduces administration costs. So that's why the premiums in group life are cheaper than individual life. So when it comes to group policies or group policy contributing and non-contributing. So when a group life insurance is contributing, that means that both the employer and the employees are paying the premiums. At least 75% of eligible employees must be covered. So with group life insurance, it definitely helps for the company's benefits plan. Having group life insurance or having life insurance in general, whether if it's contributing or non-contributing in companies, a lot of people will go to a company because of their benefits that they have that they just don't have necessarily with other companies. So both the employees and the employer will share the cost of the premiums. And this will require 75% of participation from eligible employees. Alright, so when we see group policy or group life insurance policy that's non-contributing, what does that look like? So with non-contributing, the employers pay 100% of the premiums and require 100% eligible employees participation. So with contributory, we need 75% participation. With non-contributory, we need 100%. And that may be a test question that may be asked. And then another thing with group life insurance is when we talk about key person, which we're going to talk about in another video, key person is an example of third-party ownership. So anytime somebody different owns your policy than the insured, that's called third party, which we talked about in another video. This is an example of third-party ownership. Group life insurance is an example of third-party ownership. Group life insurance policy is written as an annual renewable term life. So that's cool. So with group life insurance, when it comes to converting, you do get that opportunity. That comes with group life insurance. I think they expect people to go to individual policy. So with group life insurance policy, they expect, so similar to term life insurance that we talked about in the other video, it's the same concept with group life insurance. You get the opportunity to convert your group insurance to an individual coverage without evidence of insurability, just as long as it's in between that 31-day window of opportunity to increase or to switch out your individual policy to, or your group insurance policy to individual policy. So once that happens, the group policy will be terminated. So the rates will be standard rates based off of the insured age. Now, keep in mind that when you're converting from group life insurance policy to individual life insurance policy, the premiums are going to be higher. So what happens if your life insurance policy, if you die between, or if death occurs between converting from group insurance policy to individual policy? Well, with the group insurance policy, the death benefit must be paid. So even if no individual policy has been applied for at that time, they still have that group life insurance policy that's going to be effective or be relevant with the death benefit. And that's what they're going to use to pay out the death benefit, is the group life insurance policy. All right, so the next thing on our list to talk about is credit life. So credit life is kind of like decreasing term. So credit life is a unique form of group life insurance. Credit life is life insurance issued on an individual who owes money. So this guarantees that the individual becomes, so this guarantees that if the individual becomes disabled or even passes away, the balance of the debt will be paid. So that's very similar to decreasing term. It's another word that's used for it. So with decreasing term or credit life, the amount owed will decrease as the payments are made. So you have mortgage, or you have medical bills or something like that you're trying to pay down. You can have a credit life, so you're paying down that debt. So every time you make a payment on your premiums, well, that is helping you pay down your debt that you owe. So credit is written on a group basis. Alright, so tax rules for premiums and proceeds. So there are rules that come with premiums and proceeds and payments. So what are those? So these tax rules will affect the way life insurance policies, premiums, and proceeds are paid. So, a couple things to remember with these rules. There are 3 rules. So, premiums that are paid on life insurance are not tax deductible. Death benefits made to the beneficiary are not taxed as income. So you can't write that off as your income. You can't put that as a write-off on your income or as one of your incomes when you do your taxes. Any interest earned on death benefit will be taxable for the beneficiary. Any interest earned will be taxable, which we talked about in like variable whole life, universal life. We talked about that already. So this pretty much concludes the video. In this video, we talked about variable whole life insurance, universal life insurance, joint, survivorship, juvenile, max. We talked about credit life, group life. We talked about a lot of different things in this short 36-minute video. But if you have any questions or you just want to go back and watch the video, be sure to get a better understanding of what's going on. And if you like content like this, be sure to subscribe. If you have any questions, comments below, be sure to subscribe. Now, if you're somebody that's just watching this video because you're looking around, thinking about getting life insurance, and you have not yet found an agent, I'll be more than glad to help you get you a free quote set up, free rate set up, and also if you're really interested in building a legacy or making sure that your family is protected, then be sure to set up either a 15 to 30 minute meeting on my schedule, and I'll be glad to meet with you and talk about life insurance, what type of life insurance you would like, how much life insurance you would like, and how long would you like to have your life insurance policy in effect. And with that being said, guys, if you like videos like this, like I said, subscribe, hit the notification bell, and I'll see you on the next video. Peace.